I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website dollarcollapse.com. Welcome back to the show, John.
Hey, Jim. Interesting day to be talking, isn't it?
Well, from my little rough calculations in my head, the Dow has lost 1,000 points in 2 days.
Oh, the Dow just lost 1,200 points.
Yeah.
Today.
Yeah.
And then 666 points on Friday. So we're approaching 2,000 points in 2 days, which that means lots of things. First of all, it had gotten way ahead of itself. U.S. stocks and really global stocks. They just went up too far, too fast, and had to come back down because they had really, really stretched whatever kind of valuation measure you want to use. They were unrealistically expensive. So they should come back down just based on the speed of the move and the height that they had reached. But there are lots of reasons to be pessimistic in general about equity prices in particular and financial asset prices in general. They've just gotten so far ahead of themselves that just based on valuation, we're headed for another crash. In other words, U.S. stocks are priced about the way they were before the 2000 dot-com bubble and the 2008 housing bust. And both of those times, the resulting stock market action was cataclysmic. So based on valuation, we're getting what we deserve right now. But there are lots of other reasons that this is happening when it's happening as well. And one is interest rates going up. We've had a literally 30-some year bull market in bonds, which is the same thing as saying that interest rates have been going down for as long as most people have been alive. And they've reached levels around the world that are unsustainably low. And they had to go back up. But of course, if interest rates go up, that means the value of bonds, which are basically just loan agreements that pay you money over time, and therefore fluctuate in value with the value of the currency and with the interest rate you can get on other things, the value of bonds go down. So bond funds around the world, which are much bigger in the aggregate than stock funds out there, have gotten whacked in the last few months as interest rates have gone up. There are trillions and trillions of dollars of embedded losses in the bond fund complex around the world. And that eventually had to affect stock prices for a couple of reasons. One is it just decreases the amount of wealth in the world. And the other is that it creates competition for stocks because as bonds yield more and more, they're better investments relative to equities. So it was inevitable that rising interest rates would whack stock prices at some point, and we just had it happen quickly instead of slowly, with probably more to come. There's no way to know what happens tomorrow, but over the next few years, you would expect equities to underperform on a global basis their past 10 years because they had an amazing stretch, and for them to have another amazing stretch would mean that they would have to go to valuation levels that are just so unjustifiable that it's almost impossible. So we're kind of getting what the fundamentals say we should be getting. And the question becomes, does an equities bear market impact Main Street? In other words, does that cause a recession, which affects the real economy, throws people out of work and stuff? We'll see. Historically, it can do that. There's something called the wealth effect, where people who lose money in the stock market tend to feel poorer and stupider and less likely, therefore, to do aggressive things with debt. In other words, they don't max out their credit cards and take vacations, and they don't buy brand new cars if their stock portfolios are down, and that slows the economy. So there are real-world ramifications to volatility in the stock market, and we will see this time around if they play out that way.
We'll have more with John Rubino right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with John Rubino. Now, you did talk about, does a stock market decline lead to a decline in the economy? Is it just the whole idea that if the stock market doesn't work, your economy isn't working, even though they're two different things?
Well, they're very much related. The stock market is basically the aggregate value of the public businesses in an economy. So when the economy is doing well, those businesses are valuable, and the stock market is high, and vice versa. But it can also work the other way. When the value of equities is falling, then the health of the real economy, the non-financial economy, is less than it would have been otherwise. So, you can have feedback loops that begin in different places, but end up in the same place. And in our case, we've had a really good long run of 8 or 9 years of improving economic growth and more and more people being hired and wages recently starting to go up and immense wealth being created for the rich people of the United States, at least, and to an extent, the rich people of the rest of the world. All of those things makes growth positive. In other words, it makes the big numbers that the government tells us about the economy look pretty good. And that's what's happened lately. But we've had to borrow so much money to get that growth that the impact of that immense amounts of debt we've taken on going forward is going to be to slow things down. If you borrow a lot of money personally, right, you're going to spend less going forward because you've already borrowed and spent about as much as you can do. If you max out a bunch of credit cards, the next credit card is hard, and the one after that is even harder, and so you do tend to spend less. And an economy works the same way. It's just a bunch of people in the aggregate borrowing and spending, right? And if in the aggregate we've borrowed and spent too much in the past decade, or in our case, like 4 decades, then it gets harder and harder to generate what looks like good growth going forward. And you can argue about whether our measurement of growth and the metrics we use is valid. That's a separate thing, but also an interesting thing that we can talk about another time probably if you want. But for now, suffice it to say that we've borrowed so much money that the news is going to be, in general, on balance, bad over the next 10 years, just because that's how debt works, In 1929, we borrowed way too much money. We got the Great Depression. Since that time, or since the 1970s, we've been borrowing huge amounts year after year after year, and we've created conditions that are a lot more extreme than in 1929. So there's a very good chance that the kind of economic disruption that we have going forward because of all this debt is much worse in a lot of ways than what happened in the 1930s. And it's going to be exacerbated by the actions of absolutely clueless governments and central banks that think the way you fix excessive debt, which leads to financial bubbles, which leads to crashes, is with more debt. So they just want to leverage us further and further each time there's a crisis. They encourage us to borrow even more, and the governments themselves borrow more, and it ends up with a bigger crisis out there because the debt is the thing that causes the crisis. So that's what they'll try to do when this next one hits. And by that time, we'll be so far into experimental policies that there's no way to know what they'll do. They're going to do massively negative interest rates and government deficits that even dwarf those of the Obama years, which is saying something. Since we borrowed $1 trillion a year on average for 8 straight years. So all that stuff is coming, Jim. Which is to say that the things that seem normal based on the experience of the last 30 or 40 years will fall by the wayside and be replaced by new stuff that is anything but normal and will seem crazy to a lot of people. And then the question becomes, how do you manage your own life and your family's welfare through something like that?
Well, it's people like you we talk to try to get a handle on it.
Yeah, and it's quite an intellectual challenge trying to figure out how to make money and how to protect yourself in a world that we've never seen before. We're heading into completely uncharted territory, although there are some principles that hopefully still apply. And if you look at those principles, which is to say that too much debt leads to financial instability, which leads to either inflation, some kind of currency crisis, or a debt-driven crash. And that historically, the way people have gotten through periods like that in reasonably good shape has been to focus on real assets. In other words, own things that have utility and shy away from financial assets that derive their value from the management of governments, because governments are flaking out and they're going to make gigantic mistakes, and you won't be able to trust their bonds, for instance, or their fiat currencies, or anything that's a derivative of things like that. So the things that will be best to own in that kind of an environment are real, gold and silver, real forms of money that governments cannot inflate away. Farmland, something that always gives you something that you need, There's always going to be a demand for food, even when, we're selling our London penthouses and RVs are going for 15 cents on the dollar, and you can't get rid of a motorcycle, and big pickup trucks are 1/3 their sticker price a year after you buy them. Stuff like that is going to be all true. When people have to sell their big toys, gold and silver and farmland will still be as valuable as they were to begin with, and so that's the kind of thing that you want to load up on while you're trying to pay off debt and shedding your big toys and, living a cleaner, simpler life. And by doing all of those things, you increase the odds that you'll get through what's coming in pretty good shape. There are no guarantees in life, but a simple, relatively debt-free life with relatively few big, expensive, high-maintenance toys and a large amount of real money, like gold and silver, that's the best profile going into what's coming.
We'll have more with John Rubino right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're speaking with John Rubino. John, Bitcoin, other cyber currencies or cryptocurrencies taking a huge whack, and they started about 3 weeks ago. And somebody else told me that when you have a huge asset bubble in one area, it'll let go first before you see the stock markets hit. That's exactly what has happened. Can you tell us why the cryptos are on the way down right now?
Well, 2 or 3 reasons for cryptos. And one is that they've just had an insane run. I mean, that was arguably the biggest run any financial asset has ever had. Bitcoin went from next to nothing a few years ago to $20,000. It's hard to calculate the percentage move that represents. And a lot of other cryptocurrencies had similar arcs when they went public, were released to the public, and then just took off. Well, that's not the kind of thing that can go on forever. So even in a bull market where it's a legitimate asset and it's going to go up in price for a much longer time, you still have really serious corrections. So the question with Bitcoin, for instance, going from $20,000 to around $7,000 today, is this, a normal correction in a secular bull market that still has legs, and then it's going to go a lot further from here? Or did Bitcoin, in particular, and cryptocurrencies in general, turn out to be kind of a fad that doesn't actually have any utility in this world and that will fade away with time? And I tend to think that the underlying technology, the blockchain technology that allows cryptocurrencies to function, has a lot of uses, So it could well be that a lot of the cryptocurrencies fall by the wayside, but blockchain itself ends up being a world-changing innovation, sort of like the internet. A lot of internet companies that were big and valuable in the 1990s ceased to exist in the 2000s, but the internet itself went on to change the world. It could be that the underlying technology of cryptocurrencies does that, but that doesn't mean any individual cryptocurrency is guaranteed to survive and thrive over the next decade. And that's what we don't know, because this is such a new thing that who knows if Bitcoin is the cryptocurrency that ends up being the Amazon of the blockchain world, or maybe they're pets.com and they're going to fall by the wayside and go out of business. We don't know that. And I don't have the technical chops to even, venture a guess about whether Litecoin or Ethereum or Bitcoin is going to be the one or the handful of cryptocurrencies that end up making it in the end. But having said all that, I think the idea of private sector virtual money is really interesting, and I think it is going to be a story that we pay attention to because it's going to be consequential for quite a while. And one interesting angle in the cryptocurrency space now is that they're combining it with gold. They're bringing out gold-based cryptocurrencies in which some gold sits in a super safe vault, presumably in a trusted place, managed in a way that you can trust, so that you know the gold is going to be there, and you can trade ownership of that gold via some kind of a cryptocurrency that allows you to move it instantly anywhere in the world. See, that's one of the big drawbacks of precious metals is they're not super portable. You can't take a suitcase full of gold on an airplane. Or if you try to do it, put it this way, there are going to be a lot of questions, and it's going to be a very unpleasant process for you. But if you can have gold stored in, say, a Hong Kong vault that is insured by a third party that has, a long history of doing a good job of insuring stuff like that, and then you can move that gold or move ownership of that gold instantly with a mouse click via a cryptocurrency, that makes gold kind of a 21st century money. So all of a sudden, this old physical money that works very well on its own terms but has some drawbacks, notably portability, suddenly it's portable. And so it doesn't have the kind of drawbacks that it used to have, but it's also a zero inflation currency, so you trust it more than you trust these fiat currencies. And because of that, it maybe becomes the favored money of the world again. And I think that's a dynamic that's completely possible when you combine the advantages of a blockchain ledger with the advantages of precious metals, real money that can't be inflated away by governments. And that's one of the interesting things that we will see play out over the next few years. We'll find out if that's true, what I've been saying, and find out if it works. And if so, we'll see what kind of an impact that has on the global monetary system.
Well, one of the advantages of having crypto gold is that there's a real asset attached to it. So even if the currency goes down in value, you still have something, whereas the current Bitcoin, there's nothing behind it.
Yeah, Bitcoin can cease to exist. For instance, if somebody comes up with a better cryptocurrency, some technical fix that makes this new crypto token work better than Bitcoin does as a currency, then everybody will just shift over to that new token and Bitcoin will just vaporize, right? Well, gold, as you said, is a real thing that exists in a real place in limited quantity. You can't make more gold except by digging it out of the ground, and that limits its growth, maybe 1 or 2% a year. So to the extent that you can protect that gold, that you can, guarantee its safety and stability, then you've got an asset that will preserve purchasing power over not just weeks or months, but over centuries. I think it's a fairly safe bet that at least over the last 3,000 years, you've been able to put gold away, come back 50 years later, and have it be pretty much worth the same thing that you put in there to begin with, And I think that's going to be true for a long time into the future. And if so, it makes gold a vastly superior basis for the global monetary system than the dollar or the euro or the yen or these currencies that depend on the competence and the honesty of government officials, which it hasn't really gone very well so far. And because of that, I think that'll be one of the stories of the next decade, is gold's reemergence as a monetary asset that people actually think of as money rather than as an investment as they think of it now. So we'll see. But I think that's one of the hopeful stories going forward. There are a few others, not as many as there should be, but some good things are happening in the world and will continue to happen. And gold's reemergence in combination with the blockchain is probably one of the good stories.
Well, people are also putting a lot of thought into what they call the energy metals, things like cobalt that you need if you're going to build all these electric cars.
Yes, those are investments. That's not a monetary asset, but it's potentially a really valuable asset because, if electric cars take over the auto market, which looks like they're doing, I think within a decade, when you and I, Jim, go out to buy a new car, we're not even going to think about internal combustion engine cars. We're going to look at the range of electric cars available to us and decide what we want. Now, of course, it could be that we'll buy a fuel cell car instead of a battery-operated electric car. But to the extent that batteries remain the main way that electric cars are powered, then the metals that go into those batteries are going to be needed in vast quantities. And it's cobalt, and a couple of other ones. And lithium, of course. I was thinking of trying to find lithium, and a few others. And they're going to be extremely valuable. And also copper, apparently, is a really big deal in electric motors. So good old Mr. Copper, Dr. Copper, is probably going to go up in value if the electric car thing happens the way it looks like it's going to. So those are investments really in the clean tech space, although, picking a mining stock and thinking of it as a clean tech investment is complex. There are aspects of it that are positive for the environment and aspects that are negative. And the same thing is true with batteries in general. They're not using fossil fuels when you drive an electric car, but there are other aspects of the creation of a battery that aren't so clean. So you got to think that through. And that industry has to think it through too, because if they want to attract people who are motivated by the environmental impact of the things they buy, then they need to be able to minimize their footprint. So we'll see how that all goes. But I think in general, an electric car powered by solar energy, in other words, a solar farm somewhere instead of a coal-fired power plant, is a much cleaner proposition potentially than a pickup truck burning gas. So to the extent that electric cars spread, that's a net positive for the environment, as long as they spread along with solar power and wind power and maybe biofuels, things like that, that allow us to generate the electricity that power the batteries in a clean way. So lots of things have to happen, but in general, that's a positive story that's going to make a lot of people a lot of money if they do it right.
Do you think President Trump would want more coal burned to power electric cars?
Well, I don't think it matters what anybody in charge of any government thinks now. These technologies have arrived, and there's nothing that needs to be done as far as subsidies or trade barriers or anything like that. Now, none of those things can stop the emergence of solar power and electric cars. And in part, that's because Silicon Valley loves this stuff. And Silicon Valley is more powerful than Wall Street or Washington, D.C.
MIT has just found a way to make plants emit light by injecting them with microcarbon particles.
Yeah. If you look at the list of breakthroughs in this field, it's astounding the stuff they're coming up with. Now, 90% of those breakthroughs will never make it out of the lab. They'll never be commercialized. But it's even 1% of the stuff that you see happening out there turns out to be real. They're world-changing. And I'm talking about batteries that are 10 times as powerful as what we've got now, and solar cells that are twice as efficient and half the cost. And there's stuff like that being developed. And when the 1% or 10% or whatever of those things that are actually commercially viable hit the market, then it's a total game changer. And there's nothing Donald Trump can do about it. And it's really not even necessary to maintain the subsidies that we've had on these technologies in the past. You can just turn them loose now. And solar power, completely unsubsidized, will vaporize the coal industry within a decade and vaporize the internal combustion engine market within another decade. So it's coming, and we just have to get out of the way. Now, that doesn't mean it solves the problems that we created in the past. We've still got a debt-driven catastrophe ahead of us, and we arguably have some environmental problems that are, the equivalent of like the bad version of Y2K, back when all the computers were going to crash, when the date changed to 2000. We've got some environmental things like that going on out there. Plastics in the ocean, where they're breaking up into tiny little particles that are totally polluting everything. And all these, the sea life has this stuff embedded in their tissues and everything. We might be destroying the ocean food chain, for instance. That's something that that solar power won't fix. And electric cars won't help at all, and we have to get past that. But if we don't have a combination of a financial crisis and an environmental crisis at the same time, we'll come out of this. We'll be okay 30 or 40 or 50 years from now. But there are a lot of hurdles in the meantime that we've got to get past because of the mistakes that we made over the past 50 years.
Well, a few years ago, I did a story for the Goddard Report that was unique because I asked, has anybody studied the impact of humans ingesting plastic from their seafood? Because they found all the fish were eating that plastic. Mm-hmm. Nobody has done any studies on what that's going to do to us in the long term.
Well, I think it's less about what it does to us than what it does to fish, because if the fish disappear, it doesn't matter. We're not going to be eating them whether they're good for us or not, because they're going to be gone. And that's not that outrageous of a statement based on a lot of what seems to be happening. We are seriously messing up the ocean's ability to maintain the current ecosystem on a lot of different levels. We're acidifying the ocean, which affects anything with a calcium-based shell, and all that plastic out there that everything's eating. We don't know what a huge concentration of plastic microparticles will do to big fish or whales or sharks or anything, and that remains to be seen. So it's just bad however you look at it, and we need to fix it in a hurry. So, the final piece of the clean tech puzzle in that case is bioplastics. So we replace today's plastics with a new kind of plastic made from plants that biodegrades. So you throw it away and it disappears in a few years. Hopefully in a non-polluting way. It remains to be seen how all this stuff plays out exactly, but that's the idea of bioplastic. And it could be that we need to do something extreme to replace existing plastic with other kinds of packaging and structural stuff and whatever else we use plastic for quickly. And it might have to be something that is one of those things, like what we did with the ozone layer, where we made certain classes of chemicals just illegal. We might have to do that soon with plastic, based on how serious the ocean studies seem to be.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Questions for us or the show, or our guests, that would be everybody, can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.